Hello, I'm John A.G., and what I'm about to describe is the moment confidence quietly broke. Not with a headline, not with a panic alert, but with something far more dangerous. Reassurance. You were told Friday was the release valve. You were told the pressure had finally escaped. You were told that after gold suffered its worst single-day collapse since 1983 and silver experienced its most violent drop since the Hunt brothers implosion, the selling had run its course. Margin calls were settled. Weak hands were flushed. Pain had already been paid for. The bottom was supposedly in. Calm was restored. And then Monday arrived and erased that illusion entirely. Gold didn't stabilize, it fell another 6%. Silver didn't bounce, it collapsed another 12%. What looked like exhaustion turned out to be acceleration. As I'm recording this, the precious metals market has erased more value in 3 trading sessions than most investors believed possible just a week ago. Gold is now trading near $4,538 per ounce, down from record highs above $5,500 just days earlier. Nearly $1,000 per ounce vanished. Silver is trading around $74.36, down from levels above $120, almost half its value gone in moments. If you were fully positioned heading into this week, these aren't paper losses. This is portfolio damage that lingers for years. And if you bought the dip on Friday believing you were being disciplined while others panicked, you just paid tuition for the most unforgiving lesson in markets. Never assume the knife has finished falling. Before anything else, I need to be precise. What we're witnessing is not ordinary behavior. This is not a healthy retracement. This is not profit-taking after a strong rally. This is a cascading liquidation, a feedback-driven unwind where each lower price manufactures a new seller. Every attempt to call a bottom is being overrun. Every confident forecast is being invalidated in real time, and unless you understand that dynamic clearly, you risk misreading what happens next and positioning yourself exactly wrong when it matters most. Let's walk through Monday, because the anatomy of this session explains why the selling intensified instead of stabilizing. The Asian markets opened already under heavy pressure. The weekend didn't deliver relief. There were no emergency interventions, no surprise policy reversals, no headlines to rescue sentiment. Instead, investors had 48 hours to sit with Friday's collapse and decide how exposed they truly were. When markets reopened, their answer was simple. Reduce risk immediately. Gold opened lower and continued lower. Silver followed the same path. There were no sustained rebounds, no relief rallies that held, no meaningful pauses, just uninterrupted selling that pushed prices to levels that would have seemed implausible only days earlier. By the end of the Asian session, gold was down more than 9% from Friday's already damaged close, touching lows near $4,430. Silver dropped 15%, trading below $72 at its worst point. These are not incremental moves. These are life-altering numbers for anyone heavily allocated. And this wasn't isolated. Equity markets across Asia were hit hard. South Korea's Kospi fell over 5%. Hong Kong's Hang Seng dropped 3%. Japan's Nikkei declined more than 1%. Oil prices plunged over 5% after major producers agreed to maintain output levels, reinforcing the risk-off tone. This was global deleveraging, not a metal-specific story. But precious metals absorbed the heaviest damage, and that distinction matters because it tells us what kind of trade is being unwound. There are multiple forces feeding this decline, and they are reinforcing each other in a vicious loop. The first is the dollar. The US dollar index has risen roughly 0.8% in just a few sessions. In currency terms, that is a sharp move because gold and silver are priced in dollars. A stronger dollar directly pressures prices lower by reducing demand from non-dollar buyers. In a fragile market, even marginal demand destruction has outsized effects. Each tick higher in the dollar tightens the noose. That dollar strength isn't random. It's tied directly to the nomination of Kevin Warsh. Markets view Warsh as a monetary hawk, someone aligned with tighter policy and price stability. His nomination signals a possible shift in Federal Reserve direction, one that supports the dollar and challenges the assumptions that powered the metals rally. Gold and silver surged on expectations of rate cuts, dollar weakness, persistent inflation risk, and continued erosion of confidence in fiat discipline. Warsh's presence calls every one of those assumptions into question simultaneously. If policy remains tighter for longer, non-yielding assets face a higher opportunity cost. The market is repricing that reality violently and without patience. The second force is margin pressure, and this is where damage accelerates. After Friday's historic collapse, the CME raised margin requirements. Gold margins moved from 6% to 8%. Silver margins jumped from 11% to 15%. These changes took effect Monday after the close. In practical terms, that means traders suddenly need over 30% more collateral to hold the same positions. For gold, roughly 33% more. For silver, closer to 36% more. For anyone already underwater, this is catastrophic. They don't have excess capital waiting. Their only option is to cut exposure. And cutting exposure means selling into weakness. This is how corrections become crashes. Price declines trigger margin calls. Margin calls force selling. Selling drives prices lower. Lower prices trigger more margin calls. The spiral feeds itself until forced sellers are completely exhausted. And crucially, that process doesn't resolve in hours. It unfolds over days. The margin increases only just went into effect. The liquidation they trigger is still playing out. The third factor is profit preservation. Gold rose roughly 65% in 2025. Silver surged approximately 145%. In early 2026 alone, gold added another 24% and silver another 61%. These are extraordinary gains. But gains that exist only on paper disappear quickly when sentiment flips. Investors who rode the rally without taking profits are now watching accumulated gains evaporate session by session. At some point, fear overrides conviction. Selling becomes a defensive act, not a strategic one. That pressure compounds forced liquidation and trend-based selling, creating overwhelming supply. The fourth factor is narrative reversal. One of the most powerful drivers of the rally was concern over Federal Reserve independence. Investors feared political interference would weaken monetary discipline. Gold and silver became hedges against that scenario. Wersch's nomination disrupted that narrative. He is widely viewed as a defender of institutional credibility. His presence suggests a desire for stability, not accommodation. As that perception spreads, the urgency to hedge against monetary mismanagement fades. The independence premium embedded in precious metals prices is being unwound in real time. This is the backdrop: a stronger dollar, higher margins, profit protection, narrative collapse. Each reinforces the other. And this is why the selling didn't stop when it was supposed to. It was never just about price, it was about structure. And structure doesn't resolve gently. To understand where this goes next, you have to step away from emotion and look at how markets actually digest shocks of this magnitude. Violent sell-offs are rarely about a single trigger. They are about alignment, when multiple pressures hit at the same time and reinforce one another. That alignment is exactly what we're seeing now. And it's why calling a bottom prematurely has been so costly. Analysts watching this unfold are divided, but their language reveals something important. Christopher Forbes, head of Asia and the Middle East at CMC Markets, described gold's collapse as an air pocket following an extraordinary run. That phrase matters. An air pocket implies sudden loss of support, not fundamental failure. It suggests prices rose faster than positioning could safely absorb, leaving nothing underneath when sentiment shifted. Forbes pointed to profit-taking, dollar strength, and fresh political signals from Washington as the forces knocking excess out of a crowded trade. Excess is the key word. Excess leverage, excess optimism, excess confidence in a single narrative. Forbes was careful not to declare the bull market dead. Instead, he emphasized volatility. He expects gold to remain elevated but unstable as markets reassess policy direction and macro conditions. That assessment reflects reality. The old framework has been disrupted, but no replacement has fully emerged, and markets hate vacuums. Until clarity returns, instability dominates. What's notable is that even cautious analysts maintain a longer-term bullish bias. Forbes explicitly said gold could revisit recent highs over a 12-month horizon if rate cuts resume and inflation and growth remain uneven. He pointed out that renewed dollar weakness or confirmation of a more accommodative stance would bring buyers back quickly. In other words, the structural drivers haven't disappeared. They've been temporarily overshadowed. But markets don't trade structure alone. They trade timing, liquidity, and positioning. And right now, those forces are hostile. It's also critical to put these losses in perspective, even though doing so feels uncomfortable. After this historic collapse, silver is still up roughly 16% year to date. That's less than 3 weeks into the year. A 16% return in that time frame is extraordinary under normal conditions. Gold remains up around 8% year to date. Again, in under 3 weeks. The pain feels extreme because of how fast gains were erased, not because the rally never existed. Looking back at 2025 reinforces that context. Gold's 65% annual gain was its strongest performance since 1979. Silver's roughly 145% surge dramatically outpaced gold. These were generational moves. Moves like that inevitably attract leverage. They attract late entrants. They attract traders who assume momentum is permanent. When reversals come, they are never gentle. The real question now isn't whether the sell-off has been severe. That's obvious. The real question is how this process ends. And the honest answer is uncomfortable. No one knows the precise bottom. Anyone claiming otherwise is guessing. Markets form bottoms through exhaustion, not prediction. There are, however, signals worth watching. The first is volume behavior. In cascading sell-offs, prices typically open lower, trade lower all session, and close near the lows. That pattern reflects dominance by sellers. A potential exhaustion signal appears when prices still gap down but reverse intraday and close well off the lows on heavy volume. That doesn't guarantee a bottom, but it suggests sellers are losing control. The second signal is margin pressure resolution. The CME margin increases have only just taken effect. Forced liquidation triggered by those changes doesn't resolve instantly. It takes days as traders either post additional collateral or reduce exposure. Until that process fully plays out, selling pressure remains structurally embedded. Once forced sellers are flushed, the character of price action often changes abruptly. The third signal is the dollar. Dollar strength has been a major headwind. If the dollar's rally stalls or reverses, it removes a critical source of downward pressure. Precious metals respond quickly to currency shifts. Any sign of dollar exhaustion would be meaningful. The fourth signal involves policy clarity. Right now, markets are projecting Kevin Warsh's historical views forward without confirmation. Federal Reserve leadership often evolves once in office. If Warsh signals flexibility, concern about growth, or openness to easing, expectations would adjust rapidly. Even a subtle change in tone could alter market psychology. Technical levels also matter, not as prediction tools, but as behavioral markers. Gold is approaching longer-term moving averages and structural support zones where long-term capital often engages. If those levels hold, it suggests accumulation. If they fail, the downside extends. Positioning decisions in this environment require restraint. If you're already holding precious metals, panic selling after a crash of this magnitude locks in maximum damage. Unless leverage forces your hand, reacting emotionally now rarely improves outcomes. Crashes feel endless while they're happening, but they always exhaust eventually. For those considering new positions, patience is essential. Trying to catch the exact bottom carries poor risk-reward. Being early feels smart until it isn't. Waiting for stabilization, even if it means missing the first portion of a rebound, dramatically reduces risk. Markets reward survival before timing. For observers on the sidelines, this is a preparation phase. Volatility creates opportunity, but opportunity doesn't vanish instantly. If a recovery develops, it unfolds over weeks and months, not minutes. There is time. Zooming out further, it's important not to lose sight of the long-term framework. Government debt levels remain historically elevated. Currency debasement pressures persist. Central banks continue accumulating gold. Industrial demand for silver from energy and electronics continues expanding. Geopolitical uncertainty remains unresolved. None of these forces disappeared in 3 trading sessions. What changed was sentiment, positioning, narrative dominance. Those elements are fluid. What's bearish today can become bullish tomorrow. The very factors driving selling now could reverse under different conditions. If growth slows, policy shifts. If inflation proves stubborn, hard assets regain favor. None of the current pressures are permanent. The danger lies in confusing short-term price action with long-term invalidation. Markets routinely overshoot in both directions. Excess builds quietly, then unwinds violently. The unwind feels like failure, even when the underlying case remains intact. This is where discipline matters. Position sizing, avoiding excessive leverage, accepting volatility as the cost of participation. Surviving the short term is what allows participation in the long term. Investors are rarely taken out by being wrong once. They're taken out by being forced to act at the worst possible moment. What we're witnessing is not just a price correction. It's a stress test of strategies, of assumptions, of emotional resilience. It exposes who was prepared and who was carried by momentum. And that brings us to the most important question, not where prices go tomorrow, but how you respond now. Do you freeze? Do you chase? Do you reassess calmly? Markets don't pause for emotional recovery. They keep moving. Your ability to stay engaged depends on how you navigate moments like this. The selling will stop. It always does. What matters is whether you remain positioned to benefit when it does, or whether this phase removes you from the game entirely. When markets move this fast, the temptation is to believe something irreversible has happened, that a line has been crossed, that the story has ended. But history shows that moments like this are rarely endings. They are transitions. The danger is not the volatility itself. The danger is misinterpreting what volatility is actually signaling. We are only 3 trading sessions into what may ultimately be remembered as one of the sharpest reversals in precious metals history. Gold has lost nearly $1,000 from its peak. Silver has shed close to $50. Enormous wealth has been created and destroyed in a matter of days. That kind of move doesn't happen in a vacuum. It reveals the hidden structure beneath the rally that preceded it. Leverage was everywhere. Futures exposure expanded rapidly as prices climbed. Speculative positioning reached extremes. Confidence in a single narrative hardened into assumption. Many participants stopped asking what could go wrong because price action itself seemed to provide the answer. When markets reward behavior long enough, they convince participants that risk has disappeared. That illusion is always temporary. The collapse has stripped that illusion away. It has exposed how dependent prices had become on a narrow set of expectations: rate cuts, dollar weakness, institutional credibility concerns. When even one of those pillars wobbled, the entire structure destabilized. When several shifted at once, it collapsed under its own weight. Crashes are brutal teachers, but they are honest ones. They clarify what was real and what was borrowed. They show which positions were built on conviction and which were built on momentum. They reveal whether strategies were resilient or fragile. None of that feels helpful in the moment, but it becomes invaluable afterward. The key mistake many investors make is assuming that pain equals finality, that because the drop was violent, the outcome must be permanent. But markets don't function on morality. They don't reward optimism or punish fear. They process information, rebalance exposure, and move on. What matters now is understanding where we are in that process. We are not at resolution yet. Forced liquidation is still working through the system. Margin adjustments are still reshaping positioning. Policy expectations are still being repriced. That means volatility remains likely. Stability comes later. This is why timing matters less than behavior. The wrong response now can do more damage than the move itself. Panic selling after a historic decline locks in losses at precisely the moment optionality is greatest. Overconfidence in a quick rebound risks compounding damage if conditions deteriorate further. Both extremes are costly. The most productive stance is controlled patience. Observe how price reacts to stress. Watch whether declines begin to lose momentum. Notice whether selling pressure becomes less coordinated. Pay attention to whether bad news stops pushing prices materially lower. These are subtle signals, but they are the language markets use to communicate transition. It's also important to recognize that bottoms are not events, they are processes. They form when selling pressure exhausts itself and buyers slowly regain confidence. That doesn't happen in a straight line, it happens through false starts, retests, and volatility that feels uncomfortable precisely because it lacks clarity. Many investors fixate on calling the exact low. That impulse is understandable, but misguided. Catching the bottom is not necessary to benefit from a recovery. What matters is participating after the risk of further forced liquidation has diminished. Missing the first portion of a rebound is a small price to pay for avoiding catastrophic timing errors. Looking ahead, several paths could stabilize the market. A pause in dollar strength would ease pressure immediately. Clear guidance from policymakers could recalibrate expectations. Economic data signaling slowdown could revive the case for accommodation. Any of these developments would alter sentiment quickly, but it's equally possible that none arrive immediately. In that scenario, prices may grind lower or churn sideways as excess positioning is worked off. That process feels frustrating, but it serves a purpose. It rebuilds a base. It redistributes exposure from weak hands to stronger ones. It creates conditions where future rallies are healthier. The long-term fundamentals haven't vanished. Debt burdens remain historically high. Fiscal discipline remains uneven. Central banks continue diversifying reserves. Industrial demand for silver continues expanding through electrification and energy transition. Geopolitical uncertainty hasn't resolved. These forces don't operate on a 3-day timetable. What has shifted is the market's willingness to price those forces aggressively without confirmation. That willingness may return, but it will require rebuilding trust. Trust in policy signals, trust in macro stability, trust in liquidity conditions. Trust takes time. This is why crashes feel disorienting. They compress time. They force repricing faster than human psychology can comfortably process. Investors feel whiplash not because they lack intelligence, but because markets are operating at a different scale. The question now is not whether the rally will resume tomorrow. It's whether participants can recalibrate expectations without abandoning discipline. Those who manage that transition tend to survive. Those who don't are often forced out before conditions improve. It's worth remembering that some of the strongest bull markets in history were born from moments that felt indistinguishable from collapse. The path from fear to opportunity is never straight. It requires endurance. If you are still holding, the priority is preserving flexibility. Avoid decisions driven purely by emotion. If leverage threatens your position, address it proactively rather than reactively. If your exposure aligns with long-term objectives and is properly sized, volatility alone is not a reason to abandon it. If you are considering entry, wait for evidence. Let the market show you that forced selling has diminished. Let price action confirm stabilization. Opportunity doesn't disappear because you waited. It improves because risk declines. If you are observing from the sidelines, this is a moment to learn. Watch how narratives shift. Watch how liquidity behaves. Watch how confidence erodes and slowly rebuilds. These cycles repeat, even if the specifics change. What we are living through now will be studied later. Not just for its price moves, but for what it revealed about modern markets. The speed, the leverage, the sensitivity to narrative, the fragility beneath apparent strength. This episode doesn't invalidate precious metals as assets. It reminds participants that even favored assets are subject to discipline. That momentum without structure eventually corrects. That humility is a survival skill in markets. The most dangerous belief right now is that this experience defines the future. It doesn't. It defines a chapter. What comes next will be shaped by how participants adapt. Markets are unforgiving, but they are not malicious. They respond to behavior, they reward preparation, they punish complacency. The lesson here is not that opportunity is gone, it's that opportunity demands respect. The selling will end. It always does. When it does, the environment will look very different from today. Clarity will return, gradually. Volatility will recede. New narratives will emerge. Some will fail, others will endure. Your task is not to predict that moment perfectly. It's to remain capable of acting when it arrives. That means managing risk now, preserving capital, preserving perspective. The darkest moments in markets often feel endless while they're unfolding, but they are also the moments that reset conditions for the next phase. Whether that phase becomes opportunity or regret depends less on price and more on behavior. Stay disciplined, stay patient, and remember that survival is the prerequisite for participation.